Hi, everyone. Welcome to our channel, where we simplify complex insurance topics for future insurance professionals. Today, we're diving deep into the purpose and characteristics of underwriting life insurance. If you're studying for your insurance license, this video is packed with everything you need to know. We'll cover key concepts, agent responsibilities, insurable interest, the underwriting process, and more. Let's get started. 1. The purpose and characteristics of underwriting life insurance. Insurance companies want to sell policies, but they also need to be careful about who they insure. Issuing a policy to someone who's uninsurable can lead to financial losses. That's where underwriting comes in. The primary goal of underwriting is to protect the insurer against adverse selection. What's adverse selection? It's when people who are higher risks, like those in poor health, are more likely to apply for insurance. For example, someone with a life-threatening illness is more likely to seek coverage than someone in perfect health. Underwriters help reduce this risk by carefully evaluating applicants. Each insurer sets its own standards for what makes someone insurable. Underwriters review every applicant to see if they meet these standards. The two key questions they ask are: 1. Does an insurable interest exist between the applicant and the insured? 2. Is the applicant insurable? The goal is to classify risks properly, whether they're preferred, standard, or substandard. 2. Agent responsibility. Agents play a crucial role in underwriting. They act in a fiduciary capacity, meaning they must act in the best interest of their clients. If an agent makes an honest mistake, it's called an error and omission, E&O. That's why many agents carry E&O insurance. As a field underwriter, the agent is responsible for 1. Properly soliciting clients. 2. Completing applications accurately. 3. Collecting the initial premium. 4. Issuing receipts. These tasks are vital to the underwriting process. 3. Proper solicitation. Agents must focus on soliciting profitable business that fits the insurer's underwriting guidelines. At the same time, they must maintain high professional standards when dealing with clients. 4. Does insurable interest exist? Insurable interest is a must in life insurance. It means the policy owner would suffer a financial or emotional loss if the insured dies. For example, 1. You have an unlimited insurable interest in your own life. 2. Spouses have insurable interest in each other. 3. Parents have insurable interest in their children. 4. Businesses have insurable interest in key employees. Insurable interest must exist at the time the policy is issued, but not necessarily at the time of death. 5. Amount of insurable interest. The amount of insurable interest is based on the principle of indemnity, which means the policy should restore the insured to their original financial condition. No better, no worse. For example, 1. A homeowner can insure their house for up to its replacement cost. 2. In life insurance, the amount is often limited by what the insurer is willing to offer and what the policy owner can afford. For instance, a parent with $50,000 in coverage might only be allowed to buy $25,000 in coverage for their child. 6. Is the proposed insured insurable? Underwriters determine if the proposed insured is insurable by evaluating their risk profile. For a risk to be insurable, it must meet certain criteria. 1. The loss must be accidental and measurable. 2. It must not involve a chance for financial gain. 3. The loss must be significant but not catastrophic. 4. The premium must be reasonable. Underwriters use tools like mortality tables to predict the likelihood of death based on age and gender. 7. Parties involved in underwriting. Several parties are involved in underwriting. 1. Producer, agent, completes the application and collects premiums. 2. Applicant, the person applying for insurance. 3. Proposed insured, the person whose life is being insured. 4. Policy owner, the person who owns the policy and pays premiums. 5. Underwriter, evaluates the application and determines risk. For example, if Franny applies for a policy on her son, she's the applicant and policy owner, while her son is the proposed insured. 8. The underwriting process. Underwriters assess risks by reviewing 1. The application. 2. Medical reports. 3. Attending physician statements. 4. Credit reports. The larger the policy, the more thorough the underwriting. For smaller policies, a non-medical application might suffice. 9. Pre-selection and post-selection activities. Before submitting an application, agents must 1. Obtain complete and accurate answers. 2. Explain possible underwriting outcomes. 3. Stress the importance of honesty. After submission, underwriters 1. Evaluate the risk using all available information. 2. Classify the applicant as preferred, standard, or substandard. 10. Underwriting outcomes. Underwriting decisions affect everyone. 1. The insurer determines if the risk is acceptable. 2. The insured decides if they can get coverage. 3. The agent determines if they earn a commission. 11. Disclosures agents must provide. 1. A life insurance buyer's guide. 2. A policy summary detailing premiums, benefits, and more. They must also ensure the applicant signs forms authorizing the insurer to obtain medical and consumer reports. And that's a comprehensive breakdown of life insurance underwriting and policy issuance. If you found this video helpful, don't forget to like, subscribe, and hit the bell icon for more insurance tips. Good luck with your studies, and I'll see you in the next video.